Okay, good morning everyone, and welcome to our 5th New South Wales Dairy Breakfast. It's a pleasure to have you all. We've got over 50 registrants. I'm not sure how many we've got on the call at the moment, but we are going to kick off on time because we have a bit to get through. For those of you that don't know me, I'm Sheena Carter, Development Officer with the DPI Dairy team, based up in the Hunter Valley, Scone part of the world. Just to remind you, we are recording the session and it will be made available later. Our agenda today, we're going to have a bit of a look at some project work that we have been doing, looking at the last 10 years of New South Wales Dairy Farm Monitor, which is, it's a big milestone for us and the industry, and we're fortunate to have those 10 years of data there that we can do things like we're about to do, and potentially more work with it in the future. We were going to have an update on feed and grain markets, but unfortunately our commodities guy with the grains industries had a few disasters happen and can't make it this morning, but we can signpost you to some other really good resources around grains information and pricing. And we will also have Neville Janke from Feed Central give us an update on the fodder market. So before we kick off into our presentations, I'd like to acknowledge the traditional owners of the lands on which we are meeting today and elders past, present and emerging. So the format is we will go through the presentations. We've got quite a bit of information for you and we will take questions at the end of the sessions. So first of all, I would like to introduce Tori Alexander. Tori has been doing a lot of work on this 10-year project for Dairy Farm Monitor with the team, which has involved Tori, Nico, myself, and Helen Quinn and Fiona Smith. But I'll hand over to you, Tori, to introduce further.
Thank you, Sheena, and thank you everyone for joining in this morning. So yeah, like Sheena said, we have been working on a project that has been looking at the cumulative 10 years of data that we have from Dairy Farm Monitor project in New South Wales, and looking at trends and insights into the project, into businesses in their profitability and productivity. So just a quick recap for anyone who might not be familiar with Dairy Farm Monitor project. It is a national project run through Dairy Australia, and in New South Wales, the New South Wales Department of Primary Industries is working with Dairy Australia to run it, and it commenced in New South Wales in the 2011-12 financial year. And the purpose of the project is to provide a comprehensive physical and financial analysis of dairy farms in New South Wales. So we have farms participating each year, so data is collected annually. Those farms may change from year to year, and it's a voluntary participation, so we are very grateful to the farmers who are involved in the project, and we try to have farms that are as representative of the New South Wales industry as we can have, and from the data that we collect, we run an analysis to do benchmarking and give an indication on productivity and profitability, and there's an element of industry sentiment that's included as well. And the information is then used so that farmers and service providers can make informed decisions. And there's platforms such as Dairybase where you can go to explore the data, like go online and have a look at it. Next one, Sheena, please. So for the project that we are specifically talking about today, which is looking at the trends and insights of the last 10 years of New South Wales DFMP. This project was funded by the New South Wales Farm Business Resilience Program. And as Sheena's mentioned, there's a number of people on the team doing this work, and that is Sheena, myself, Nico and Juan from New South Wales DPI, as well as Fiona Smith and Helen Quinn. And part of the outcomes of this project is that we'll produce a report that includes the data analysis. We've also got 3 videos that we're producing about the Dairy Farm Monitor project. And we've also created an interactive tool, which I believe Nico is going to be introducing a little bit later this morning. And these resources will make available to you as soon as they're up online. So you'll get an email when they're ready. So just before we delve into the data, it's important to remember that over the course of the 10 years, there's a lot of factors, both internal and external, to a dairy business that can influence the data that we're getting out of the farms. And even though we can get some really good information from a year-to-year basis, dairy farms, like other businesses, have to be able to run long-term. So it's really important that we can understand what's happening long-term. And that's one of the exciting parts of this project, is we're getting to look at, we've got the data available and we're looking at what's been happening from a business perspective across a longer period of time. So within the 10 years that the project has been running in New South Wales, we've had a number of floods, bushfires and drought, as well as then there's factors like the changes in milk pricing, and we've got people factors as well, so how owner-operator decisions can influence the individual farm's performance as well. So over the 10 years that the Dairy Farm Monitor project has been operating in New South Wales, we've had 78 farms participate in the project. Now, in order to look at data over a period of time, we created a selection criteria, which was that to be included in this current 10-year analysis, a farm has to have participated in Dairy Farm Monitor project for a minimum of 3 consecutive years. So once we went through and determined which farms met that criteria, we ended up with 48 farms remaining in the data set. And as you can see in that graph there, they're pretty well spread over from 3 to 10 years. We had a fairly good amount of farms per year throughout the whole 3 to 10 year cumulative participation. Once we had determined the farms that were going to be included in the data set, we then wanted to classify them into one of 2 groups, and that was either main cohort or the top 25 group. And to classify them into the top 25 group, we did this on a per year basis. So in one financial year, if that farm had either EBIT or ROTA in the top quartile, then they were classified as a top 25 farm for that year. So it was possible that a farm could be a top 25 farm in one financial year and another financial year not. And that led to us having approximately 30% of the data being classified as a top 25 group. So when we see some results in a sec, that's how those groups were determined. And obviously the rest were then classified as the main cohort. So I'll just pass over to Sheena now, and she'll go through some of the results that we've got.
Thanks, Tori. And your work behind the scenes has been invaluable and also one. Can I just ask if everyone could please put themselves on mute unless you're speaking as well. You can do that up in the screen where your picture is and hover over, there's mute and unmute. Just please make sure that you're on mute. So look, there is a lot of information that we can draw on when we're looking at 10 years of data. And what you're going to look at is going to be dependent on the questions that you're asking. This presentation is going to focus on some key areas that we've decided to look at that have some impact on farm profitability. So in particular, we'll be looking at things like cow efficiency and labour efficiency and some of the major costs in a dairy business. But look, this is really a starting point. So I would encourage any of you who have questions you'd like to ask about the data within the limitations of how the data is presented to us in Farm Monitor, please reach out. We'd like to do some more with this work moving forward. So if we look at the 10 years of data, so our orange line on the graphs is going to be our top 25% farms. So those top 25% based on return on total assets or EBIT, as Tori's already outlined. And the blue line is our main cohort of farms, so the rest of the farms in that data set. When we look at Dairy Farm Monitor generally from year to year, we do tend to report on the average of the state, and we further split it into north and south. And we do some reporting on the top 25, but we haven't looked at the data where we've separated out the top 25% of farms and compared that to the rest like this before. So we can see here in this graph, when we're looking at return on total assets managed over the whole 10-year period, that our top 25% farms, this looks, they're averaging around a 6% return on total assets over that 10-year period. So look, this is it's comparable to alternative areas of investment outside of agriculture, which indicates there is reward in operating a dairy business well. And this doesn't factor in any growth in real estate or land value, which, as we're certainly seeing at the moment, this goes up with time as well. So profitability is impacted by many things, including milk price. However, we'll see through this 10-year data set that our top 25% farms aren't receiving the highest milk price. In the 12-13 year, for example, where we had the impact of some tier 2 milk pricing, we had the lowest average milk price across the state at that point. And we still had our top 25 farms with an average EBIT of $1.43 per kilo milk solids. So for those that are aware, there's an industry target for a sustainable dairy business to be achieving $1.50 per kilo milk solids over 3 years out of every 5. So these businesses, what is it about them? They have a management ability that sees them make informed and timely decisions that optimise their business performance, and they run efficient businesses with good cost control. If we look at their costs of production, again, we sort of see they tend to have a lower cost of production than the rest of the farms. So obviously this is going to be related to profitability. If you have the ability to spend the money in the right areas of the business, so those areas that drive operational performance. And we still see the impact here where we've got costs of production influenced by some of those seasonal factors like drought that Tori mentioned earlier. If we look at the relationship between milk price and cost of production, this is quite a complex area, and this graph is obviously, it's got data points from different years, different seasons, different milk pricing in there. But we can see a slight trend that as milk price or as cost of production increases, milk price increases, or vice versa, whichever way you want to look at it. But we see that these top 25% farms tend to have that lower cost of production, and they aren't all getting the highest milk price. So we need to caution looking at this graph too. Low milk prices and low costs of production aren't going to be sustainable for any business in the medium to long term. You can have a really low cost of production in years where you need to, but it needs to be sustainable. So I think over the 10-year period, our top 25 farms have averaged a cost of production of about $6.64, and the rest have averaged a cost of production of around $8.57. If we look at the physical characteristics, and I'm looking at total usable area here of the business, so the milking platform and all the support areas, the top 25 farms do tend on average to have slightly more land available to them. This helps them focus on producing more of their own homegrown feed, which often carries a lower cost relative to purchase feed. So this reduces their risk profile with less exposure to the volatile purchased feeds markets, as we've seen in the last couple of years. And many of them are also, or some of them are also using larger usable areas to run integrated beef operations or rear more young stock for sale. We see that, so this is milk solids produced per cow on average over a year. So we see that these top 25% farms tend to produce more milk per cow. This doesn't tell us how efficient they are, merely that they've got good production. But if we look at cow efficiency, we can see that they are actually managing their cows to be more efficient producers. Now, this is multifactorial, as we know. Ultimately, I guess, coming down to management ability, with these managers getting many things right, including things like milking the right type of cow for their system. They've got good pasture management skills. If they're a pasture-based farm, they grow quality feed, they graze it at the right time, they have low wastage, so they're utilising all the feed, as much of the feed that they're growing as they can. And they have good feed conversion efficiency, and they manage their herd health and fertility really well. That all helps drive cow efficiency. If we look at cow efficiency in relation to operating profit or EBIT, so just a refresher for cow efficiency, what we're trying to achieve is a cow efficiency of 1, which means for every kilo of live weight of the cow, we're generating 1 kilo of milk solids. So a ratio of 1 is 100% efficient, greater than 1, more than 100% efficient, less than 1, less efficient. Now, again, this graph's a little challenging because we've got multiple years, different pricing and seasonal conditions throughout this 10-year period. But it does show that unless you're one of the top performers, it can be very difficult with inefficient cows to generate a sustainable profit. And we need to be careful also pushing cow efficiency. It's a bit like if we want to use a stocking rate analogy, there can be a bit of a tipping point for maximising profitability when we're looking at cow efficiency. So we sort of see once we're coming, where's my cursor gone? Once we're coming out too far, we can start to get a drop off. It's easier to look at an individual year to see this trend, but we see some really good cow efficiencies up here, but we can start to tip over at a point. And this is where we're pushing too hard to try and achieve this profitability, because quite frankly, we're spending too much on high priced feeds to lift per cow production. So we do have to be careful looking at cow efficiency. If we look at total feed costs, generally these are the largest operational cost in a dairy business, making up to 50% of total costs on average. In some years, which we've seen recently, it can be much higher than that. But so total feed costs include both homegrown feed costs and purchased feed costs. We can see that our top 25% have got a lower cost on a dollars per kilo milk solids basis. Again, we can see the influence of drought years. We've got less pasture available in the paddock. The last couple of drought years were particularly horrendous with low pasture availability, but also very, very expensive purchased feed. Now, there's a number of things that will drive efficiencies in this area. Even with homegrown feed costs, high costs in this area aren't necessarily due to high input costs, so our high irrigation or fertiliser costs, but they can be related to low levels of pasture utilisation or low pasture quality. So getting your pasture and grazing management levels is very important. Make sure you're growing quality pasture, utilising as much of that as you can. Otherwise, you're growing expensive feed that isn't being utilised by the cows to generate milk production. I guess one of the other factors in this, when we're looking at our top 25 farms, they tend to be in regions where they have a closer proximity to grain and fodder markets. There's areas of New South Wales that are further from these markets, and that certainly adds cost to purchase feed costs with freight, particularly at the moment with fuel costs on top of that as well. So, they're growing, these top guys are growing good feed, they're feeding quality feed, and they're feeding it well. If we look at total overheads, so overhead costs are the fixed costs in our business, and the big ticket items here are really our labour costs, so paid and imputed labour costs, repairs and maintenance, and depreciation. So we see with our top 25% farms, they've got good cost control in this area, which again, it's multifactorial. The challenge is that if overhead costs take up a large proportion of your total costs, then you've got less cash available in the business to drive production income in variable cost areas. So, producing or sourcing good quality feed. If we look at other factors impacting high overheads, a lack of investment in on-farm infrastructure will also result in increased repairs and maintenance and labour's costs. So an example of this might be a shed or farm laneways that are past their use-by date, and this results in longer milking times, delays in getting cows back to the paddocks, or slow movement to and from the paddocks. And all this adds to inefficient use of labour and labour cost. Another factor could be overcapitalisation. So this will impact depreciation cost and also high repairs and maintenance if we've got too much machinery. It can be a bit difficult for some of our smaller farms, and I'll pinch a phrase from Fiona Smith. She says the fact is it's not possible to have half a tractor, half a ute, and half a motorbike. So these smaller businesses, they still wear the costs of repairs and maintenance and depreciation with plant and equipment that isn't fully utilised in the business. This graph is showing so total production for a year in kilos of milk solids against our total overhead costs. So there's a bit of a point where these smaller businesses, unless you've got a very efficient business with good cost control, there tends to be insufficient production in these businesses to dilute the overhead costs. So consequently, they're then making up a larger proportion of the overhead costs in the business. So there is a bit of a challenge there for these smaller businesses. We still do see that we've got some businesses down here that are smaller in production, but they're quite efficient in their cost control. If we look at labour, labour costs average around 25% of total costs in a business, and so labour efficiency is very important in a business, and it is a real challenge in New South Wales with some of our farm layouts and farm systems and farm size as well. So over the 10-year period, if we look at the top 25% of farms, we see they're generally more efficient with their labour use. So they've averaged around 45,000 kilos of milk solids per full-time equivalent. So per full-time equivalent labour unit, which is 2,400 hours for a labour unit in a year. And this is compared to about 35,000 kilos of milk solids per FTE in the main cohort. So our top farms are about 33% more efficient than the others. So and there's a couple of things in this graph. I guess we can see with our top 25, there was sort of a decline in labour productivity over this period, but it has certainly improved in the last couple of years. Whereas with the rest of the farms, it's kind of stagnated our labour efficiency. We haven't seen much productivity gain here. Now, as I've already mentioned, it's things around farm layout and infrastructure, having good farm layout for ease of cow movement, good laneways to help with cow movement, good water supply sources strategically around the farm. If we have a lack of investment in these areas of the business, we get these inefficiencies in the business with labour use and labour cost. So this graph just reflects total labour costs. So when we're talking total labour costs, we're talking paid labour and imputed labour. So generally that imputed labour is family owner operator labour. We did do as part of another project, interestingly enough, the DPI did do a survey into investment in the New South Wales dairy industry. It wasn't related to dairy farm monitor farms, it was just farms in general. And if we looked, it looked at investment over the last 5 years and intention for investment in the coming 5 years. And this tended to indicate that the larger farms, and large farms in this case was 300 cows or more, they tended to have invested more in their businesses than the smaller farms. And the main areas of investment were in mobile plant and equipment, milking shed and plant, and farm road repairs and livestock handling infrastructures. So these are all going to help their sort of capital expenses that are going to help operational efficiency in your business. So I guess that's probably it at this point for our presentation on our deep dive. We do have lots more data, but time's kind of limiting what we're presenting this morning. I guess the key messages from what we've looked at so far is that there is reward in dairying. The returns are comparative to alternative investment sources, as we've seen by our top 25% farms. The key drivers of their consistency are their cost control and efficiency. So they've got good labour efficiency, good cow efficiency. They spend money in the right areas of their business and good management skills. So they make generally the right decisions at the right time and understand their farm system very well. So I think I will leave it there at that point. And our next part, we'll come back to questions afterwards. Our next session is with Nico, and Nico is going to introduce our interactive Dairy Farm Monitor report, which sits on our website. So over to you, Nico.
Thank you very much, Sheena. Great presentation. And as you said, these are some of the findings of this project. There will be more in the final report. I would also like to encourage anyone that wants to ask questions to type them in the chat, and we'll tackle them after this short couple of slides that I've got. So I just want to share with you the interactive tool that was developed as part of this project. Juan Garjulo, that works in the DPI Dairy team, he led the development of this tool, and he works closely with Sheena, Tori, Helen, Fiona, and myself to bring it up kind of to life. The link to the tool is there on the screen, and I'll put it in the chat now. But basically, this tool, what we were trying to achieve is, as part of the Dairy Farm Monitor project, all the participating farms receive an individual report of that year, and that includes some information of the previous years. And to industry, we release again an annual report that gives highlights of the overall average results, and then split into North and South, as Sheena had mentioned. We thought there was an opportunity to build some type of tool to show this data in a bit of a more interactive way. So what we basically did is Juan developed this platform where it takes all the data of Dairy Farm Monitor, not only for that year, but also for all the years back. If we go one, can you advance one, Sheena, please? So basically, one of the key screens is this graphs and figures that basically show you for a group or one farm for a particular year, what is achieved. So for example, in this graph on the screen at the moment, you see all the participating farms for the year 2020, 2021, then color coded in the graph for North and South, and you see the average in the bottom for physical and financial parameters. So it's a bit of a more visual way of showing this. You can then select a individual farm for a particular year to show you the same things in the graph. If you advance one more, Sheena, please. So this is, for example, you're selecting farm 29 in the South for 2020, 2021. And again, it shows you the average return on assets on the top and some key average physical and financial parameters in the bottom. So we believe this is a much more visual and easier way to see these things rather than going through the report and try to compare trends in time. Then there's also another tab that shows historical information where you can select kind of a series of variables, again, either physical or financial, to show how they change across the year that the project has been running. So we see, for example, in the graph to the left, kilograms of milk solids per FTE for North and South farms from the start of the project till now. So you can see the evolution of the historical trend of that. The same to the right, return on total assets. So again, we are inviting everybody to explore this. I'll put the link in the chat now, but please feel free to have a look at it, explore, and any feedback, we are more than welcome to take it on board and see how can we improve this moving forward. The important thing is that it becomes a platform that we can build on from here. So kind of us from 3 days from now, we start capturing data for 2021, 2022 year. And when those results are ready, we'll incorporate those results to this tool. So it'll build on from here onwards. So that's probably it. Sheena, from my end, we can probably tackle a couple of questions.
Yes, let's, thanks, Nico. And I hope that people do take the opportunity to have a look at that interactive report and provide us with feedback. It's definitely an easier way to look at the data if you're a visual person rather than running through tables of numbers, whether you're a farm monitor farmer or a service provider, industry person, another farmer trying to look at some of these metrics. It's quite good. So questions. What have we got? Sorry, Nico, I haven't looked in the
No, it's fine. There's a couple in the chat if you
box.
want. Yeah, I can read them, but there's one. Are you seeing the common factors over time that make a farm more likely to be in the top 25, such as location, farm size, or system?
Yeah, I guess if we look at the top 25% farms in this data set, they do tend to be, let's say, in regions, more the southern regions and inland regions. And again, I've mentioned some of the factors that are driving their performance in those regions, particularly the inland regions and far south inland, that they have got access to more usable area to grow a lot of their own homegrown feed and minimise some of that risk in the business, or whether it's generating some additional income through fodder sales or a beef component to their enterprise, or selling breeding stock back into the industry or to the export market. They've got that proximity to fodder markets. We can see a difference in cost of purchased feeds between north and south, depending where they're sourcing it from, of around $40 to $50, and that's predominantly that freight cost of getting feed to different regions. So that can be a risk factor for businesses if you're not able to either source feed nearby or grow a lot of your own feed. Yes, so and a lot of it's their farm layout and systems, understanding their resources and what they've got and being able to manage them well. So they've had that ability to reinvest back into the business, and as I mentioned, in those areas that are improving farm infrastructure, but that then has a flow-on benefit for operational expenses in the business, with easier use of time for people's time, easier movement of cows throughout the farm, all those sorts of things. So there are those sort of commonalities for sure. Is there another one, Nico?
Sorry, I've got a question there, Sheena, but haven't written it in there, sorry. Taking a different slightly view on those consistently in the top 25%, At the beginning of the presentation, you talked around how many farms had been in Dairy Farm Monitor for the extended period. Is there any correlation between them consistently being part of the Dairy Farm Monitor report and then translating that into a top 25%?
Not necessarily, Jono. No. No, and look, I think, you know, Dairy Farm Monitor is very much, it's a fantastic thing in that it does give farmers really good information about their businesses. It's what they choose to do with that information. So, you know, they get the reports, but as part of Dairy Farm Monitor, the project itself, they don't get, you know, a consultant sitting down with them and going through that, trying to lift their performance, because if we do that to Dairy Farm Monitor farms, then we're lifting the performance of a select group of farms within the industry, and then we're not probably reflecting the actual performance of industry. So, but in saying that, there are, obviously these farms have got this information. If they choose to use it, they can certainly use it wisely to understand their businesses, understand where the strengths or weaknesses are in their business, talk to their consultants, their advisors, their farm team, and try and identify ways to improve their performance. And I think, you know, as an industry, yes, this isn't part of Dairy Farm Monitor project itself, but certainly within New South Wales, we've got the Business Support Services project where farmers have an opportunity to get a one-on-one with a consultant to sit through whether they're a farm monitor farm or whether they're a farm with a dairy-based report or a farm business snapshot report. There's that support there for people to look at their data and make some decisions. I mean, even as many of you know, and Jono, you will know better than a lot of people on the call, there's, you know, national programs to help farmers in this space, such as Our Farm, Our Plan, and all, you know, all the farm business management programs to help farmers with their financial literacy and understanding their business performance. So there is certainly support within the industry to help people shift their business performance if that's what they want to do. That was a long-winded answer. Sorry, Jono.
And Sheena, can I just jump into just with a couple of things with the last couple of questions is firstly, I guess in regards to your question, Jono, that it's not, we have to bear in mind that farms aren't consistently in the Dairy Farm Monitor project, so they're coming in and out all the time. And there were 9 farms that were in the project for all 10 years, and then the rest of the farms were for various numbers of years. So whilst there are those handful of farms, out of 78 farms, 9 out of 78 were in it the whole time. The rest were coming in and out for various lengths of time. So they're not always consistently in the project. And then also going back to the previous question of whether there were things we're seeing between the top 25 farms in the main cohort, like defining characteristics that that maybe you could say was different between the two groups. Again, what Sheena said, that we're just seeing trends in things. It's not set in stone that if you have X number of cows, you will be a top 25 farm, or if you're in this location, you will be. There's so many factors that are playing on what's leading to a farm being a top performing farm. But then again, like the average herd size was a little bit higher for a top 25 farm, but looking at average herd size, for example, there's a range. So then there's this overlap that it's possible to be a top performing farm when you're outside of that range, as well as it is also possible to be in the main cohort group when you're in that sort of sweet spot range, so to speak, of herd size. So it's not that you have to reach a target and therefore you will be a top performing farm.
Any more questions we need to address? Because we do have a couple of other things to do before we move on to Neville. No? Okay, so I guess to wrap up that session, a big thank you to the Farm Resilience Program, Farm Business Resilience Program, for their support in undertaking that work. It's been a great opportunity for us, and we hope to do more with it in the future. And also thanks to the team that have been involved, our DPI Dairy team, but particularly Fiona Smith and also Helen Quinn at Dairy Australia. Their support has been invaluable. Now, hang on, I need to get my thingy work. Right.
Just before we move on, if you wouldn't mind, for those participating today, if you could quickly, it'll take 30 seconds to a minute, if you could just quickly open another browser up on another window up on your browser, on your phone or computer, wherever you're viewing on, and just type in slido.com or www.slido.com. This is just a very, very quick survey on behalf of the Farm Business Resilience Program. They have funded this work that we've presented today. It's just to get some feedback for them on, you'll see the questions. There's 5 questions. They're very quick, simple ones to answer, and it's anonymous feedback that they would like to collect, which they use to help with their decision making on what projects to fund in the future. So they look at, you know, what the impact of projects they have funded, such as this one, and feedback and that sort of thing to then fund things in the future. So we would appreciate, and so would the Farm Business Resilience Program, if you could just take a quick sec to jump over and complete that survey for us, please.
Okay, so I'll just give everyone a couple of minutes to do that.
Oh, yes, and once you go on, there'll be a code you have to enter, like a hashtag code, and you just type in dairy, and that will be the code to get you in. If anyone does have trouble getting on, that QR code on the screen too does work as well.
Yeah, that's how I did it. Being, you know, through COVID for the last 2 years, I'm pretty good at scanning QR codes, although I'm getting a bit out of practice at the moment. Phone hasn't forgotten how to do it though. All right. Sorry, there's just a few things up in the chat. Oh, that was you, was it? QR code worked well via my phone. Thanks, Mitchell. All right, I'll let you finish your Slido survey, and if you could send that in, that would be greatly appreciated. Thank you. Our next presentation was going to involve 2 people, but we do have Neville with us today. So I have a couple of slides from Neville. So Neville is Regional Sales Manager and Fertiliser Specialist with Feed Central. Now, Feed Central have got an online platform that enables farmers to source, analyse and procure different sources of fodder. So they're one of many options available to farmers out in the market for purchasing feed. Neville's going to give us an update on the quality and pricing of what's in the market at the moment in what has been a very wet autumn and winter period for many farmers in New South Wales. So we know there's been lots of challenges with feed, homegrown feed. The wet weather, the flooding was at a terrible time of year for many in terms of either conserving silage, getting corn crops off, and even, you know, doing their usual autumn pasture sowing. It's been really difficult, and the other problem is that it's been very prolonged. So there's a lot of farmers in a tricky position, having to source more feed off farm than what they would like. So Neville, I'm going to hand over to you if you would like to take yourself off mute. And thank you very much for joining us today. It is greatly appreciated to have someone from industry talking about what they're seeing out there in the market at the moment. So thanks, Neville.
Thanks, Sheena, and thanks to all that are viewing today. Yes, I just listened with intrigue of the story that you present is one that I heard probably 20 odd years ago, as when I was in the dairy industry myself and had our own dairy herd. So, but there's been, but this, as you said, that this last autumn period, from the summer period through the autumn period, has really thrown everything at us as far as the floods went. From the southeast corner of Queensland right through New South Wales, not only one flood, but there was in some places up to 3. But it all started back before that, as far as the fodder industry went. It started back in the beginning of the summer, when there was lots of storm rains and so forth, and there was limited amounts of cereal produced into hay, just because the year didn't lend itself for that, the storms and the weather influences that came through, and it led then onto that wet time along the east coast. But that really put a dent in the amount of actual cereal hays, being oats, wheats, and barley hays that were made, and some of the ryegrasses, pasture hays into the southern Riverina and into the northern part of Victoria. So it really put a dent in the amount of production that come off some of those farms. So that, at the end of that 21 year, and then if you just reverse it back a little bit for this market, how this has all played out, we did have some good stocks of hay from the 20 year, but then the mouse plague came through, and that really tossed everything at us, as far as devastating stacks of hay going through sheds and just taking out all that supply. So we've seen some big impacts on the amounts of hay that's been downgraded, lost, and taken out of the trade. So that, on top of a lower production year in the legume side of things, in lucernes, in vetches and so forth. This year there was a lot of water damage on vetch hay across the Riverina and into the northern part of Victoria. So that took out a lot of that protein hay, and it downgraded it. So we've got in the market this year, because we've had such a drought. If we go to the next slide, Sheena, it sort of just gives then a little picture of what an old dairy farmer in Queensland told me just the other day. He said, Nev, he said, an empty hay shed in a very wet season is difficult to fill. And he was right, because the things that have been thrown at the production side of the industry to have hay in sheds for the end users, being the dairy farmers and the beef operators, it's been a very difficult one. On top of that, you've seen escalating fuel prices. We've seen escalating fertilizer prices. We've seen escalating, and we won't hear from our grain man, but we see the price of grain going right up to levels that we haven't seen for a lot of years. So the difficulties have been thrown at the industry. So where are we up to, and how much hay is in the market? I guess is what on every dairy farmer's mind, you know, where is it, what is it, and so forth. Queensland missed out completely in this last year of making hay. So if we go through the states and just give you a bit of a wrap up, Queensland missed out. There's no cereal hay made in Queensland. Very little, limited amounts of lucerne hay made anymore. And of course, Queensland, into their big feedlot industry, import at least 200,000 tonne of hay from the southern states in just to support them in any normal year. So this year being an abnormal year where there's no hay made, there could be double that amount being imported back into Queensland. So then you roll down through New South Wales and you see the impact of the wet season and so forth, and limited amounts of hay being made in that area. There was good amounts of hay made in South Australia and into the western parts of Victoria, but some of it was rain damaged. So then on top of that, you get 3 floods down along the east coast. And that the drama of then getting hay to fill sheds in a wet time is enormous. The transport difficulties, the struggles, the waterlogging, the things that happen around sheds and where you would normally turn a truck around, you just can't get them in there and you just can't get them unloaded. And traffic on highways don't like stopping for a B-double to pull up and unload 60 bales of hay for one dairy farm that you can't get a truck into. But the cows are still hungry. They still need to be fed. So the dramas that have come upon the industry and the market has driven price. And you rightly said there before, Sheena, that you're seeing a $50 increase in price in the northern parts of New South Wales to what you're seeing in the southern parts. It's just physically because there's just no hay in Queensland and there's not much hay left above Dubbo in New South Wales. There is limited supplies through Forbes, a little bit into the Riverina. But that supply has been sucked out by the farmers that have had the floods. They've needed to have product, so that's been sourced from further and further afield, and therefore the cost of transport just goes up and up and up. And of course, the increased cost of fuel on top of that. So it's just increasing the cost of fodder coming into sodden dairy operations where you actually need feed and you need good quality feed to put milk in the tank. We realise that. Lucerne prices, vetch prices, and that's so forth. We can touch on those things, I suppose. That's what you really want to hear, and you want to get your pencils out because you can fire some of these numbers down. Good quality oaten hays around that $200 to $220 a tonne at the moment. The lower grade of hays that have been weather damaged in the cereal lines, the oats, wheats, barleys, and so forth, you'll get 180s, 170, 180 ex-farm. I'll talk ex-farm gate price. All we're going to do then add freight to wherever you are up and down the coast. So you're looking, 170, 180s, better quality stuff. You're looking at 200s, 220s. Up into, if you want to get up into your higher energy, higher proteins, being 9s and 10s, energy proteins, you'll look at $250 a tonne for cereal hay, ex-farm gate. Now I'm talking Sea Lake area, which is a fair way away from the east coast, I know, but that's where the volumes of cereal hay still is. Talking now protein hays, vetch hays in the Western Districts of Victoria. There is some still 2019 vetch hay in sheds. It's around that $250 to $250 to $280 a tonne ex that Western Districts Victoria, but it's still only a 17 and 18% protein, maybe 9 ME. It's not your high protein hay. A lot of the high protein hay has been all sucked up and used. A lot of it's gone across to the Gippsland. Some of it's come up into the southern parts of New South Wales, a little bit up into the northern parts of New South Wales. Lucerne hays anywhere from $300 to $400 a tonne. $300 a tonne through the Riverina area. You're up onto $400 a tonne for the better quality 2010 type Lucerne hays out of Forbes. There is some supply still there, but that is diminishing. All these supplies won't get recharged now until we get into September and October. So we've got a long haul yet from where we are in the end of June right through until we get to the end of September, we start seeing something coming through. But there's another factor playing out, and that's the continued changes that are coming through some of the sowing areas. Southern Queensland hasn't planted too much cereal hay at the cereal crop at all at the moment. There's a little bit through Central Highlands and Central Queensland, and then you get into Central New South Wales, and there's some sowing being done. So we've got a limited amount of sowing being done because of the wet weather and not being able to get on the country. So that's going to still continue to drive the prices of cereal hays and fodder prices through this next period until we get out the other end of this winter time and we can get some spring, and then there may be some hay made. The talk on the traps is that the high grain price that's being floated around for new season grain will limit the amount of hay, cereal hays that will be made. Yes, there'll still be some legume hays being in the lucerne and vetches, but the amount of cereal hay, I think, will be limited this year. It might be one of those things where we see empty sheds in a very wet time, and then when cereal grain is at its highest number. So that's just a little wrap, Sheena. I don't know how much more you would like to tell me, other than going to the next slide. You can hop onto the Feed Central website, and you can see the quality statements of all the different hays that's available. That'll take you through whether to buy an A grade or a AA grade, the grading of the hays, and the grading of the visual grading of hays normally comes on what you can actually visually see. So that's the gloss, or that's the color, that's the texture, that's the fineness of the hay, and that's whether there's any water damage or black spot or damage to the product. But then the feed test will tell you the big story, and it'll tell you whether the quality of it that's there, the energy side of it, it'll tell you your proteins. It'll also tell you then all your minerals and elements in there, your NDFs and so forth. So that'll tell you what type the hay is and how good it is, and how it will fit in with your ration that your nutritionist can work with. So that's what the quality assurance certificate shows on all the lots of Feed Central hay. So if we go to the next slide, then it'll then give you a little bit of a visual of what you can, if you log on to the Feed Central website, you could actually get the delivered prices from the farm gate prices that I've quoted you earlier now in this presentation, but you could actually get the delivered numbers come through for lucerne hays or vetch hays delivered to your farm. That's an approximate. The number that comes up on your screen is an approximate, because some routes that a truck goes down, it's not possible for B doubles to get down, or some trucks. So we work with Google Maps, and we can try and do the best we can in getting the transport costs right to your door. But feel free to have a look through, have a surf around. You can call me anytime on the phone. I'm happy to talk through what's happening. I'm happy to talk and take questions now if you'd like, so that all can hear and understand what the problems we face from the trade side of it, trying to get the quality hay that puts milk in the tank for you guys. Because we know that the higher the energy is, the higher the protein is, the more milk in the tank. And I know that some look just for the roughage side of it, but boy, oh boy, there's not much roughage left that's of any quality at the moment. So
it looks like it's a really tight market everywhere, Neville. Yeah, and look, thank you. That is an excellent presentation, excellent picture of what's going on out there at the moment and what we're looking at coming into next season. So there's a lot of factors and a lot of challenges out there for people, and I guess with these, higher prices and lack of, shortage of supply, it really is important that people make use of things like, and your website's brilliant with your feed test results, and make sure that you're buying on quality if you're spending that money, and starting the conversation now, which I know most people have been doing anyway, because they've been living through this for the last few months, but
can
try
I
to
just
source
add
up that supply.
Sheena, can I just add one more little thing?
Yep.
Be careful buying roughages at the moment. There's no quality roughage left in the market. All the roughage has been damaged by something, be it mice, be it rain damaged. So you really can't get any value out of any roughage. You're better off getting a lower grade of cereal hay, be it oat, wheat or barley, and mixing that in as a roughage. The straws are of so poor a quality at the moment, it's not worth a dairy farmer looking at that. Right. They're okay for the beef market, into a beef ration, but not into a dairy market.
Okay, fantastic. Good tip. Does anyone have any questions for Neville while we've got him on the call? You can obviously contact him if you look at Feed Central on their website. But has anyone got any questions for Neville right at this moment, or comments? Nope. Okay, it's always a challenging time in the dairy industry. Every year I say it's the perfect storm, and every year continues to be the perfect storm. So I think, you know, there are a lot of challenges and a lot of planning, which takes people's time, effort, and energy to do this. But you know, there are people in the industry and in the market there to help you source feeds as well, such as Feed Central. So please reach out. And Neville, thank you again very much for your time. It is greatly appreciated. I know it's been a bit of a juggle to get one of you and the team on board for the call this morning. So thank you very much appreciated.
Thanks, Sheena. Thanks, guys.
Thanks. Okay, so that brings us to the end of our 5th dairy breakfast. So thank you for your attendance to all of you. And again, thanks to our presenters for their time and information. And thank you to you all for your questions and interaction. Please reach out if you'd like any additional information or have any further questions. We're happy to take them offline. If you've got any thoughts on 10 years of Dairy Farm Monitor and questions that you know, burning in the back of your mind, please reach out to myself or one of the team. We'd love to hear from you. So we will wrap it all up there and share the recording of this session after we've edited it. Thank you very much.